Hello, everyone. Thank you for being here today. My name is Amanda, and my associate's name is Tracy. We are JD Team 14. Before we jump into the substantive material, we want to make sure that our goal for you, Mr. Hopper, is to provide you legal tax advice to help minimize your tax liability while also genuinely complying with the tax code.
Well, that's great, because I definitely don't like paying taxes, and please call me Tim.
Tim, thank you. Tracy's going to provide an outline of how we're going to address the issues that you've brought to our table.
Okay, so and again, before we start, just so that we're clear, you understand that with your friend Bryce here, that any attorney-client privilege is hereby waived with this meeting.
Is that right?
That is correct, because he's not you. But I don't think there's anything here that would cause any problem. Are you okay with that?
Well, if you tell me it's okay, I mean...
It's okay for this purpose.
Okay, I just wanted to make sure that you were fully aware of that, Tim.
Thanks, Tracy.
Okay, so we figured that we would go through the matters in the order of which we believe would be of most importance to you, with the first being the petition to the tax court, which my colleague Amanda will go over and outline that. I will then discuss the matter of the OID rules, and then from there we'll go into the consideration of the gift loans that you made to a separate friend.
Okay.
Okay. Do we want to hand out the timeline events?
Oh, yeah.
Okay. Regarding the notice of determination, we're going to supply you an exhibit of the timeline of events, so it's easier to see how things played out regarding your notices.
Thank you. This is a fancy paper you have in this law firm. I hope I'm not paying for that.
Tim, you had received a notice of intent to levy on January 1st, and you responded with Form 12153 to appeal for collections due process hearing shortly after. On March 14th, the appeals officer inquired for more information, but before you could reply, you had to go out of town. The IRS followed up in April. Without hearing a word, they filed the notice of determination on June 9th. You returned home a week later, and then you were able to file your petition to the tax court on July 20th. Is that correct?
Well, yeah, but, I mean, it's not like I could have done anything. I mean, I was in this other place.
Right, I understand. So you filed the petition to the correct venue. You filed it to the tax court. That was correctly done.
Well, that's good.
Yes. But the petition was untimely according to the code of 6330. They like to see a petition filed within 30 days of the notice of determination, because the notice was on June 9th and you filed on July 20th. That was 41 days rather than the 30 days that the IRS prefers.
Yeah, but I wasn't here. Like,
exactly.
I didn't get it.
We agree. So there are defenses available regarding your situation to present this to tax court. And you can challenge your underlying tax liability as well, because you did not have an opportunity to dispute this. So we're relying on this recent Supreme Court case called Bockler, where they ruled that the 30-day time limit to file this petition is not a hard deadline. Mm-hmm. Okay? And that provides us latitude to proceed further to challenge your tax liability.
Is that automatic? I mean, it doesn't seem fair, right? That they're going to say they're not going to listen to my appeal here when, I mean, I'm stuck in this place. It's not like I could get back. Like if I got it back, I would have got it in the mail, but I wasn't. I didn't get the mail, so like it's not fair. But is it automatic or?
It is not automatic. The IRS has their rules and procedures that they have to follow, and given your extraordinary circumstance, we have to prove that it was extraordinary. Mm-hmm. And on top of that, we needed more information about what notices, if any, you received prior to your notice of intent to levy, because that will also make a difference. Did you happen to remember if you received a notice of deficiency prior to January 1st?
I thought whatever I had, I sent you guys.
Okay.
I mean,
That's fine. We can contact the IRS for to obtain records as to what has been sent.
How do you do that?
We can request a transcript from the IRS to determine what notices were sent to you related to this underlying tax liability, and then we'll be able to determine if the notice of deficiency was sent to you in the proper format, which would have been by certified or registered mail. If you did not receive that notice of deficiency, then you would not have been able to dispute the underlying tax liability, which was represented in the notice of intent to levy.
Okay.
Okay. So we can investigate that further, and then we also need to decide if it's something that you do want to pursue in court, depending on the amount of your tax liability that you're up against as well.
Do you know how much was the notice for? Do you remember?
I don't remember. You know,
Okay.
I mean, but look, I mean,
Well,
after all these loans I made, like, I'm not flush with cash here.
Well, as a practical matter, how would you advise a client in this situation? How would you rate, in comparison, his likelihood of winning versus the cost of proceeding?
So the cost of proceeding is likely to far exceed the amount that is going to be due, potentially. So obviously litigation is timely and it is costly, and during the appeals process you are responsible to continue paying the liability of that levy. And then it would only be if you won that you would receive the money back that you in fact paid. So if the money is not of substantial significance and, you know, it's maybe a few $1,000s or something like that, you may want to contact the appeals board again and attempt to work out some sort of a payment arrangement where you could pay in installments over time so that you weren't forced to pay upfront all of the money, but that you would be able to work out some sort of an installment agreement with the IRS if that was something that you were if that was acceptable to you.
So, Tim, it sounds like we need to get the total number of dollars that you owe on these notices.
Correct.
It's not in the facts that were provided to us.
Yeah,
Right.
and maybe we can match it up with these loans and start collecting the loans.
Well, we'll get to the loans in a minute.
And furthermore, it's less than 10% of cases that appeal the CDP process actually win. So keep that in mind as well.
Is it that low?
Yes.
Okay.
So if we move on to the loan that you made to your friend Royce for the purchase of your real property, we understand that the loan was made for $5 million in exchange for the sale of the property. The loan was to be due in 5 years with no interest payable on the note. And then you all modified the term of the loan to extend the term out for 10 years.
Do you know when the modification occurred? Would that matter?
No, the time of the modification doesn't matter because the amount that is the stated redemption amount is based on the total amount due with all modifications taken into consideration.
But they modified the term of the loan, not the amount of the loan.
Correct.
That's correct.
Is there an impact to just modifying the term of the loan?
No, it won't. It would not play into this situation because under your circumstances, you fall under an exception of the code which allows for certain lower amount loans to be computed at a lower interest rate than what the AFR requires to be charged. So the required interest rate at the time that you made the loan was 10%. Where you were charging no interest, the code imputes that there is some interest because there's a general principle that nobody lends money for free. So the code will impute interest into the loan.
Now, we're talking about the purchase money obligation. We have loans to talk about as well.
Those are different.
That's different.
Yeah,
Yes,
that
we'll get to the
we'll get to
capital
the
loans.
loans
You're
later.
right now talking
We're
about the
just
purchase
talking
money.
about the purchase loan for the
And-
sale of the
the good
cabin.
news is, because we have Royce here, we got to make sure we explain the consequences to the two of them. Although Royce isn't our client,
Correct.
He cares a lot about what happens to Royce. I think.
Yes.
Last time I heard.
Yes, and
Good to hear.
thank you for your time. If you want to, whenever you get done talking to them about what impact this would have to me with the transaction.
So what you're
Right,
saying. So go ahead.
Oh, I'm sorry. So because the amount of the loan is adjusted for inflation under 1274 Cap A, your loan would fall under those exceptions. So you would be below the $5,944,600 threshold that was in effect in 2019 when you made the loan to Royce. So therefore, the amount of interest that could be imputed into your loan would be 9%. But
That seems
under
pretty high. I mean, and what does it mean that, like, there's imputed interest? Like, I'm not charging interest. He's not paying me interest.
right, so
He's not paying me anything right now.
we understand, but nobody lends money without adequate interest. So a loan without adequate interest, the code will impute it anyway. So we have some.
But what does that mean? Imputed interest, like
So
being taxed on something that I'm not actually getting.
yes,
Yeah.
But
Let's be clear here. Did he lend money to Royce, or did he sell property to Royce in exchange for a note?
he sold property. He sold property in exchange for a qualified debt instrument.
Okay, and to be clear here, are the rules that apply to original issue discount under the code identical, the same rules as apply to loans?
No,
Okay. And
but this was a sale or exchange of real property.
so it's a sale or exchange, and what code section is that covered by?
1274.
Okay. And what code sections are the original issue discount rules?
1273.
1272, 1273.
1273.
Correct. And so I just want to make sure we're clear that when you think about this, we're looking at this in terms of what imputed interest he has in connection with the sale, because we'll talk about loans and other things in a few minutes. So what we're talking about here, Tim, is you sold it, you didn't charge Royce interest. The code imputes interest. When's that interest income taxable to Tim?
It is taxable annually.
Even though I'm not getting it.
Yes.
And when's it deducted by Royce?
It is deducted by Royce at maturity. I will need to look into that to make sure, to double check on that.
Okay.
It depends on how Royce is using the real property. Whether
That's
he
an Airbnb,
okay.
but we've had trouble getting it right.
Okay. So we would have to look further into that based on your usage of your cabin.
Okay, I like
So we had just maybe some suggestions in terms of potentially how, Tim, you could, potentially, if Royce was in agreement, to modify the terms of the loan so that it may be a little bit more equitable.
And so how would you modify the loan?
So
Well, first, we put it in writing, make it a formal agreement.
Would you put an interest rate on it?
yes, we would.
And what interest rate would you use?
We would use the lowest current AFR that was applicable at the time that the loan was in place.
Which AFR? There are three AFRs for.
If it was a 10-year term, we would be using the long term.
Okay. And what are the tax consequences to Tim of adding interest to the loan?
If he adds interest to the loan, he made it potentially a payment of an interest-only loan over 10 years, then Royce would be paying him the interest.
Would he have to pick up the interest? Let's assume that Royce's Airbnb isn't doing as well as he would like. If you modify it, will he have to continue to pick up the interest until it's paid?
we would need to research that further.
And what's the impact of adding interest to the loan?
If Royce is paying him, then he would at least be receiving funds for which he's reporting as income on his income tax return.
Okay, that's helpful. Would the change in the terms of the loan be a taxable transaction? You're changing the note.
Potentially, if we did a balloon at the end, then the sale would be reported at the end. So the gain for the sale of the property would still be reported at the end of the loan. So therefore, it would potentially be, still the same ultimate tax consequences to Tim, but yet he would still be receiving funds during the term of the loan.
If you want to keep the same terms of the loan, again, we would recommend putting it in writing, using the real estate as collateral, having Royce personally guarantee the loan, and recording it in the recorder's office.
Was the original loan recourse, was Royce personally obligated to pay you back? I thought. You don't give money away for free, do you? Well, of course, it's not money. It was the sale.
Look, he doesn't pay me back. I'm taking him to that place where I was when I didn't get the IRS notices, and I'm going to leave him there.
Royce, did you think you were personally obligated on the loan?
No.
Well, what did you think what do you think? Was just the cabin?
I thought he was going to come take the
cabin
back if he wanted to.
Okay, those are just recommendations, but...
Okay. But do you know whether the loan was recourse or non-recourse? Do we know?
We do not know whether the loan was recourse or non-recourse.
So let's talk about Royce for a minute. What are the tax consequences to Royce here? If he turns around and gets lucky and finds somebody who wants to buy the cabin for $5 million, what happens?
Well, he would be in a better tax situation, obviously, because his basis in the property is $5 million. So because that is what he purchased the property for. So if he sells it for $5 million, he has no gain to report.
And what's he get in he can deduct the interest now even though he's not paying it? I mean, you're a cash method taxpayer, you're not, yeah. So he's not getting any money to speak of from his Airbnb, unfortunately.
They can't, because unfortunately, under the rules of 1274 AC, Cap AC, that they can't use it as a cash method debt instrument because they exceed the stated principal amount of the loan exceeds the adjusted inflation rate. Mm-hmm. Which was a little over $4 million at the time that the loan was given. So
at that point, he has a loan where he can't be on cash method, which means they're both on accrual OID?
Well, he's still a cash method. He would have to be the accrual OID, yes.
So he has to accrue the income and he has to take the deduction. Does he have to file anything? In addition to his returns? Does he have to give a 1099?
He does not have to give a 1099 because it's a personal loan.
Well, why is it a personal loan? It's a purchase.
He's not a business. It's not a publicly traded.
Wait, you are running a business, aren't you? You're trying to.
Yeah, rental business.
Why?
But is it in his personal name?
Yeah, I just have it on my personal name.
Yeah, and until he generates some income, it's hard to deduct expenses until there's income coming in.
Well, you have a job, don't you?
I do.
Can't he use the interest that he's accruing against his other income?
Not against a trader business. Not against trader business income.
Why not?
Because the expenses would have to be attributable to the trader business.
Why?
So,
okay, we can.
So look, I think I'm paying for your time, and I'm still kind of concerned here about this, whatever you call it, OID, phantom, like I gotta...
Imputed, the foregone interest?
The imputed,
be taxed on something that, like, I mean...
The discount rate.
But, like, this loan it's been a few years.
Well, I repeat, there's not a loan here.
Well,
there's a purchase money note.
You call it whatever you want, like... it's seller financing
Yeah, you gave him seller financing.
On this thing, but like they're telling me that I have to pick up interest income,
Well,
and I haven't received it, and it's not on my returns. So what's the advice?
Well, what would you tell him? Yeah, you've given your advice. You would modify the note and have Royce pay currently.
No. That's not my question.
Our advice in terms of filing your amended returns?
Well,
we're 5 minutes.
Okay, so our advice would be that you file amended returns in order to properly report your income, the original issue discount with the IRS for the prior 3 years of the note.
Why should he amend a return? He filed what he filed.
Do I have to do that?
You're not required to do that, but if you don't, you are subject to civil and criminal penalties.
Criminal
penalties?
For failure to file a return that is accurate.
Well, I filed returns.
Even though you did not realize that you may owed imputed interests in the past years, we still recommend that you do so. If you start reporting OID and the IRS sees that you may be subject to more of an audit than what you would normally be.
If he files, though, an amended return, isn't he changing his accounting method for the OID, for the interest?
No, he can still report as a cash method for that.
Well, since we're down 5, we'd like to hear more about the other loans, but the loans. Remember, you loaned some money to Murphy, and we've only got 5 minutes left. So tell me about Murphy.
So there were 2 loans. Loan number 1 was $5,250 at 0.38%, and loan number 2 was $4,500 at 0.95%. Both loans are considered gift loans because the applicable federal rate was 1.3%.
Why are they gift loans?
Gift loans are below market loans. So if the interest rate is below the market rate of 1.3, then it's considered a gift loan. Again, imputed interest.
Doesn't a gift loan require some type of donative intent between the lender and the borrower?
That's what I'm saying. So the interest rate of 0.95 and 0.38% is well below the market rate. So therefore, implicitly, you're gifting that percentage difference to your friend.
I wanted to help him buy the whiskey. I really wasn't concerned about making a lot of money on it, but why is that a gift? He's still charging interest.
Luckily, the loan for the whiskey, which is loan number 1, the $5,250, because it was a personal use loan, there is an exception under 7872, where if the aggregate of loans are under $10,000, then the provisions don't apply. So you do not need to report unstated interest for loan number 1. Now, loan number 2 is a little different because the purpose of the loan was to open up a travel agency business by purchasing real estate. And there's an exception to the de minimis exception where if the loan proceeds are used to the acquisition of income-producing assets, assets that directly produce ordinary income, then 7872 provisions do apply. Therefore, you would have to report the unstated interest on loan number 2 because 1.3% is higher than the 0.95% that you are charging to your friend.
Now, he never got any money beyond that. You actually paid the interest, the small amount of interest Murphy paid you, right?
Yeah, I think so.
Okay. But so does he have to report the larger amount on a current basis?
Yes.
And why?
Because he has to report the foregone interest, so the difference between the 0.95% and the 1.3%, which is the 0.35%.
So he has to report it. Well, what else is happening? Is there a gift here? You're calling it a gift loan. Does he have to file a gift return?
He does not have to file a gift tax return because the amount would be well below the annual exclusion amount.
Okay.
So,
which is this year would be $17,000. Last year would be $16,000.
Okay.
So this would be reported as gross ordinary income. Any interest income would be reported as ordinary income. Now you could.
It's just totally upside down. They're like saying yet again that I have to pay tax and I'm not getting any money.
That's exactly what they're saying.
It's upside down.
Well, go ahead, since you have less than a minute left.
Well, tax equals truth. So if the rate is lower than what a standard transaction would be, as the AFR is 1.3%, then that's essentially a gift, the difference between 1.3 and 0.95, which is 0.3.
Well, so what should he do? Should he just raise the interest rate on the loan to 1.3?
He could.
Potentially.
He could, but I mean, it's minor.
Minimal.
Yeah.
It's minimal, and it depends on what that relationship matters to you, and whether you're worried about reporting 0.35% interest on a $4,200 loan over 4 years. It's going to be a pretty minimal amount of money, in addition to, because you are going to be collecting the 0.95%. So to report that additional amount, that's a personal decision, and it would really depend on your relationship with Murphy and whether or not you wanted to go back and say, hey, by the way, I have to, raise your interest rate.
Okay, thank you. We're out of time. But
Okay.
Thank you.
Thank you very
Thanks.
much.